So you did it. You saved up your first $1,000 to invest. That's a huge step, seriously. But now what? If you've looked online for advice, you've probably noticed something kind of weird. A lot of it is completely contradictory. In this explainer, we're going to cut through all that noise and break down the two main paths you're going to encounter. This question from a super popular Reddit forum is probably one of the most common questions new investors ask. That first step feels massive, right? And you just want to make sure you're not making some huge mistake right out of the gate. Before you can even think about what to buy, you really have to decide how you want to invest. All the advice online pretty much boils down to two conflicting philosophies. So let's explore both, starting with the one that promises big results and fast. All right, so path number one, we're calling this the active formula. This is all about taking a hands-on approach. The core idea here isn't just to make money, it's to try and beat the market by being a little smarter, a little more diversified than the average person. It's an exciting idea, and you'll find plenty of people online with their own very specific formulas. Here's a perfect example from a popular YouTube channel. It's called the Quadrant System. You take your $1,000 and you split it four ways. Some in a broad market fund, like the S&P 500, some in established crypto, another chunk in those big Magnificent Seven tech stocks, and the last bit in a real estate trust. The logic, as you can see, is pretty straightforward. Don't put all your eggs in one basket. Now, this slide shows you exactly why this path is so tempting. I mean, look at this. The S&P 500 had a really solid 23% return last year. Not bad at all. But the Magnificent Seven stocks, a mind-blowing 64%. That massive difference is the siren song of active investing. It's that chance to just dramatically outperform the market average, but is it the only way? And that brings us to our second path, what we're calling the simple standard. If you spend any time on investing forums for beginners, you will see this advice repeated over and over and over again. And it's pretty much the polar opposite of that complex active formula we just looked at. This quote from Reddit pretty much illustrates the entire philosophy. It's a two-step process. Buy a low-cost fund that just mirrors the 500 biggest US companies, and then just keep doing that. Forever. No crypto, no picking individual stocks, no fancy quadrants. Just buy the whole market and hold on. And here's a really powerful testimonial from that same Reddit thread. It's a cautionary tale from someone who tried to beat the market, and now, decades later, they regret it. This is the voice of experience arguing that the simple path isn't just easier, it might actually be more effective in the long run. So why is this boring strategy so popular? Well, the data really tells the story. If you look at over 150 years of market history, the S&P 500 has ended the year with a positive return about two-thirds of the time. The odds historically have just been in your favor if you buy the market and wait. It's a strategy built on probability, not on prediction. So we have two paths. One is all about outperformance, the other is about simplicity and probability. To really understand the difference between them, we need to talk about something that beginners often ignore, but professionals are absolutely obsessed with, and that's risk. Let me introduce you to the risk of ruin. This isn't just about losing some money. This is the chance that you lose so much money, you're effectively knocked out of the game completely. For any investor, but especially for a new one, the first and most important goal isn't to get rich, it's to survive. It's to avoid blowing up your account so you have time for your strategy to actually work. A key part of that risk is something called the drawdown. That's just the drop from your account's highest point down to its lowest point. Every single investor experiences drawdowns, but it's the size of that drawdown that determines whether you can stay in the game. And this is the brutal math that every new investor really needs to understand. Losing money is so much more damaging than making money is helpful. Think about it. If your $1,000 account drops to $500, that's a 50% loss. But to get back to where you started, you now need to make a 100% gain on that 500. The deeper the hole you dig, the exponentially harder it becomes to climb out. So here's the crucial point. Those aggressive, high-risk strategies that promise to turn your first 1,000 into 5,000, those are the very same strategies that maximize your risk of ruin. The desire for speed directly increases your probability of failure. It's a huge paradox. But, okay, what about the ultimate dream of active investing? Forget 64% returns, what about finding a stock that goes up 10 times in value? A multi-bagger. This is the holy grail for stock pickers. And, some people believe there's actually a secret formula to find them.
A recent working paper analyzed hundreds of stocks that produce these massive returns and came up with this list of common traits. And it looks fantastic, right? It's specific, it's data-driven, and it seems to offer a clear roadmap. Find these small, cheap, profitable companies that aren't growing recklessly. This is exactly the kind of thing active investors are looking for.
It almost seems like a cheat code for the market. But whenever you see a formula that promises these kinds of incredible results, you have to ask yourself, what's the catch? And yep, here are the catches, as pointed out by some really savvy analysts online. For one, the study wasn't peer-reviewed, but more importantly, it suffers from massive bias. The researchers started by looking at a list of stocks that had already won, and then they worked backward to see what they had in common. They completely ignored all the stocks that had the exact same characteristics but ended up failing. It's like interviewing lottery winners to find a secret and just ignoring everybody else who bought a ticket and lost. This quote from the online analysis just sums it up perfectly. The study tells you what past winners looked like, but it's essentially useless for predicting future winners. It confuses correlation with causation. Okay, so we've walked down two very different paths. We've looked at active formulas and passive investing, risk and so-called secret strategies. So what's the big takeaway for your first $1,000? Well, it all comes down to this one fundamental trade-off. Path 1, the active formula, is all about chasing a high potential reward. You might outperform for sure, but you are absolutely taking on a higher risk of ruin. Path 2, the simple standard, is optimized for something completely different, a high probability of success over the long haul. So as you make your decision, just remember these key points. Your number one goal is survival, staying in the game. Avoiding those big losses is mathematically more important than chasing huge gains. Always be skeptical of systems that sound too good to be true. And remember that the simple, boring path is the one with a century and a half of historical data backing up its long-term effectiveness. You know, ultimately, what this all shows is that the initial question might just be the wrong one. It's not just about picking a stock or a fund. It's about deciding on your entire philosophy. Are you a speculator, out there hunting for a big score? Or are you a builder, focused on compounding wealth predictably for decades? That's the real choice you're making with your first $1,000. There is a world of difference between trying to get rich quick and trying to build wealth, for sure. The path you choose now is going to define your entire investing journey.